Welcome to the deep dive. Today is for you, the learner, looking to quickly get a handle on spotting potential stock market opportunities.
That's right. We're digging into value investing versus momentum trading today.
Yeah, based on insights from investor Miss Mancy, the goal here is pretty straightforward. Give you actionable steps to understand these, well, quite different approaches.
Very different. We've got a lot to cover, so let's jump in.
Okay, first up, value investing. So this is about finding those um, maybe overlooked companies, undervalued with long-term potential.
Exactly. Hidden gems, you could say, trading below what they might really be worth. It's about finding a bargain.
So how do we actually find them? Where do we start?
Well, it usually begins with some key numbers, some metrics. Think price to earnings or PE ratio.
Right, the PE.
Yeah. If a company's PE is lower than its industry peers, say 10 versus an industry average of 20,
Yeah.
that might signal it's undervalued. It's a starting point.
Okay, lower is potentially better there. What else?
Price to book, or PB. This compares the stock price to the company's net asset value.
Net assets, like buildings, cash, equipment, minus debt.
Basically, yes. If the PB is below 1, say 0.8, it suggests you're paying 80 cents for every dollar of the company's book value. Could be a good deal.
Interesting. Any other key numbers Miss Mancy highlighted? You mentioned dividends.
Uh-huh. Dividend yield. A higher yield compared to the industry average can be attractive, especially for income. Also, debt to equity ratio, ideally below 1, showing manageable debt.
And free cash flow.
Crucial.
Right.
You want to see positive and hopefully growing free cash flow. It shows the company generates more cash than it needs to run and reinvest, which is healthy.
So where can folks find all this data easily?
Oh, lots of free places. Yahoo Finance, Google Finance, Finviz is a good one too. Just look for low PE, low PB, high dividend yield relative to the sector.
Okay, so we look up these numbers. How do we filter down the thousands of stocks out there?
That's where stock screeners come in handy. Finviz lets you filter by PE less than 15, PV less than 1, dividend yield over 3%, things like that.
So you set your criteria and it spits out a list.
Exactly. Yahoo Finance and TradingView have good screeners too. For beginners, maybe start filtering for larger companies, say market cap over $2 billion dollars, for a bit more stability.
Makes sense. So you get a list from the screener. What's next? Just buy.
Ha, definitely not. That's just step one. Next comes the real work. Fundamental research.
Okay, what does that involve? Like reading company reports?
Yep. You need to dig into their annual report, the 10K. Look for consistent revenue, how they manage debt, their growth plans.
And the quarterly ones too, the 10Q.
For sure, those give you the recent performance updates. You also need to understand their industry. Is the company struggling, or is the whole sector just having a tough time temporarily?
Right, context matters. You mentioned catalysts earlier. What are those again?
Catalysts are potential triggers that could cause the market to recognize the stock's true value. Maybe new management, a breakthrough product, favorable industry changes.
Something that could, wake the market up to this stock.
Precisely. But there's also risk, of course, which brings us to the margin of safety.
Ah, yes, the margin of safety. Buying with a discount.
Exactly. It's about buying the stock significantly below your estimate of its intrinsic or true value. The Graham number is one sort of simple formula to estimate that.
A buffer against being wrong, basically.
Right. It helps protect you. But you also need to watch out for value traps.
Value traps. Sounds ominous.
They are stocks that look cheap but just keep falling because the underlying business is actually deteriorating. Declining sales, too much debt, maybe their product is becoming obsolete.
So low price isn't everything. Fundamentals have to be solid or improving.
Absolutely. And don't forget diversification. Don't put all your hopes on one or two stocks.
Spread the risk, right? How many is good?
Maybe aim for 10, 20 value stocks across different sectors.
Yeah.
And remember, value investing is typically long-term. Think 1, 5, maybe even more years.
Patience is key then. Any final quick tips for value seekers?
Yeah, maybe follow some well-known value investors like Buffett or Graham, see how they think. Look in unpopular sectors sometimes. And try to be patient when the market is fearful.
Great summary of value. Okay, let's completely switch gears now. Momentum trading. Sounds faster.
It definitely is. Momentum is all about identifying stocks that are already moving strongly, usually upwards, and jumping on board to ride that trend for uh, shorter-term gains.
So less about underlying value, more about price movement.
Pretty much.
Yeah.
Here, timing and technical analysis are much more important.
Technical analysis.
Hmm.
Charts and indicators. What are the basics there?
You're looking for clear uptrends, stocks making higher highs and higher lows. Moving averages, like the 50-day and 200-day, help confirm the trend direction.
The 50-day moving average, I hear that one a lot.
Yeah, it's popular. If the price is above it, that's generally seen as bullish short term. Also, look at the Relative Strength Index, or RSI. In an uptrend, an RSI between 50 and 70 can suggest the momentum is strong, but maybe not yet overextended.
Okay, what else? Volume.
Volume is critical. High trading volume confirms the strength behind the price move. A breakout above a key resistance level on high volume is a classic momentum signal.
Got it. So are there screeners for momentum stocks too?
Oh yeah. FinViz, Trade Ideas, Thinkorswim platform.
Mm-hmm.
You can screen for things like price up over 20% in the past month, trading above the 50-day MA, volume over, say, 500,000 shares a day.
So you're looking for stocks already on the move with lots of interest.
Exactly. And liquidity is key. You want stocks with high volume so you can get in and out easily.
How does news play into this? Is it different than for value stocks?
Big time. News is often the catalyst for momentum. Think positive earnings surprises, a new product launch that gets buzz, strong sector trends, even social media hype sometimes.
Ah, the hype factor. Need to be careful there, I imagine.
Definitely. Hype can create momentum, but it can also disappear just as fast.
So timing is everything, you said. How do you actually time the entry and exit?
Well, common entries are right when a stock breaks above resistance on high volume, or sometimes on a pullback to a support level, like that 50-day moving average, if the overall trend is still up.
And getting out.
Exiting is just as crucial. You sell when momentum shows signs of fading, maybe the RSI gets way too high, above 70, indicating it's overbought, or the price stalls, or volume dries up on up moves. Setting price targets or using trailing stops helps automate this.
Stop losses seem non-negotiable here.
Absolutely. Always use a stop-loss order, say 5% below your entry price, to limit potential losses if the trade goes against you immediately. Discipline is paramount.
It sounds like risk management is even more intense with momentum.
It has to be. Things move fast. A common rule is to risk only 1 to 2% of your total trading capital on any single trade. Avoid having too many positions open at once, maybe just 1 to 3 active trades.
Stick to your plan, basically. Don't chase things wildly.
Right. Don't get FOMO, fear of missing out. Wait for your setup. Maybe practice on a paper trading account first to get the hang of it without risking real money.
Good advice. Any other quick tips for momentum traders?
Keep an eye on hot sectors, AI, clean energy, whatever's trending. Sector ETFs can give clues. Use real-time news and data feeds. And watch out for big price gaps at the market open.
Okay, wow. So just to recap the core difference then, value investing is like being a detective, digging for long-term fundamental worth.
Yeah, patient, research-heavy, while momentum trading is more like being a surfer, catching the short-term wave using technical signals and reacting quickly.
Very different mindsets, different toolkits.
Totally. Miss Manzi also stressed some universal tips, though. Always keep learning. Use the tech tools available. Start small, whichever path you choose. Track your performance religiously and stay plugged into market news.
Absolutely essential points. It really boils down to what fits you, doesn't it?
Exactly. Neither one is better overall. Depends on your personality, your tolerance for risk, how much time you can commit.
So the final thought for you, the learner. Does the patient hunt for hidden value appeal more? Or does the fast-paced challenge of riding market trends spark your interest? Which path feels more like you? Something to think about. Thanks for joining this deep dive.